Hello, I'm Carine Bonnejean, Managing Director Hotels at Christie Co. And today I'm joined by Saurabh Chawla, Vice President Transaction for Westmont Hospitality Group. And together we're going to explore what has happened in the hotel sector in 2024 and what we expect to see in 2025. Thank you for joining us, Saurabh.
Thank you. It's a pleasure. Thank you for having me, Carine.
So we've recently launched our new publication, Business Outlook 2025, and I wanted to take that opportunity to hear your views on what has happened in the European hotel market in 2024 and what we expect, obviously, to see this year. So what were the key market trends you saw in the market last year?
Well, 2024 was an interesting year, wasn't it, Carine? If we look at the transaction volume in 2024, it was a bit of a respite after the slumps of COVID and extending that to 23. We saw the activity rising in 2024. Of course, Europe-wide, it was way below the peaks of 2018-19. But that said, if you carve out the key markets, UK, Spain, Italy, France, Germany, in fact, they were much better than 2018 and 19. So yeah, encouraging signs, Carine.
We saw last year about 20 billion euros of transaction. That's about 50% up of the previous year. So yeah, finally, I think brokers had enough to do last year to keep them a bit busy. But obviously, as we discussed in the UK, there was mostly driven by portfolios and that was most of the market. What did you see in France and in Spain, for instance?
The activity was predominantly portfolio-based in the UK, whereas in the rest of the continental Europe, it was dominated by luxury assets or upper upscale assets. And that was a stark difference between, if you look at it on price per key basis, in the UK, most of the transactions sort of hovered around 500,000 a key or below, whereas most of the transactions in France or elsewhere were sort of almost touching $1 million a key. So that was a stark difference between the two. Italy, Spain, France, they were all up in the transaction volume compared to 2018-19. Germany was the only outlier, or one of the biggest outlier, I would say, in the sample set, where transaction volume was down 70%. There were transactions in Germany. I think largely they were on the budget side, some portfolios, but largely on the budget side. As we said, UK was predominantly portfolios. London, quite a few assets were traded, and then of course the other two portfolios. What's also interesting, and if you break it down by cities, London and Paris are still the most liquid markets in Europe. The difference, if you take London and Paris out and compare it to other markets, it's a night and day difference in terms of transaction volume. Dublin, again, no surprises there, was high up there. But again, much lower than Paris, but still for Dublin, it was quite phenomenal. That said, I think that we've seen a lot of supply issues in Ireland and specifically in Dublin. So doubt it should be able to hold on to that level coming to 2025. What was also interesting in 2024 was to see cities like Athens coming in for the first time, coming into that ranking. Ibiza, another one. What else? Madrid has been on fire. It seems like it will continue to stay for at least in the short to medium term. All the right parameters are pointing towards a good 2025, and let's hope it stays that way.
So for Westmont, what were your key focus during the previous year, and where did you spend most of your time, Saurabh, last year?
Our key focus, we were trying to identify gaps in the market. Now, what we were able to assess was France as a country has strong fundamentals. The cost of borrowing is relatively lower compared to many other European counterparts and to the UK. So we focused a lot on France. What we also focused on was Spain. We want to grow into Spain, but Spain, as we discussed, is going through a peak at the moment. There's transaction pricing, asset pricing it's really at its peak. So what we found was the gap in Spain, which is that it's actually still cheaper to build in Spain than to buy. So we entered into a partnership with Grupo Lar, a very well-respected blue chip developer, to launch greenfield developments across Spain. And the thinking is really to build at, I don't know, 120, 130 a key, and hopefully sell them at 200 a key in 4 to 5 years. So that gap is a value add, and that's something we embarked upon and spent a lot of time last year. And France as well, we looked at quite a lot of distress opportunity out there. As you may know, we were fairly successful in buying and getting 4 assets out of the Naus portfolio as well. Very pleased with that. I think that trend will continue into 2025 as well.
What was your most enjoyable years of 2024, and why, most importantly?
I would say Naus is high up there, largely because of the drama involved in the court and how it swings from one day to the other. Court processes are never easy for anyone. It's lengthy, time consuming, with very little chance of success. And you have to be strategic throughout. So that whole process, I quite enjoyed it on sort of being strategic on what we should be doing to maximize our chances of getting more out of it. Yeah, it's high up there. It was the highlight of 2024.
And did you see any other distress opportunities across Europe? Have you seen a bit more activity maybe than we've seen? Because realistically, we haven't seen much for several years. But it sounds to me that there is a bit more happening in various places.
So we are seeing distress opportunities. Whether they're trading or not is to be seen, and we will hope that they would trade in 2025. We've seen a lot of distress opportunities in Germany. We've seen a lot of German operating companies going into voluntary liquidations. We see that trend would reflect into the PropCo pricing coming down. So far in 2024, they were able to hold up to it, but we hope that in 2025 that trend would reverse and there would be a value in the mixcos, so buying the distressed opcos, distressed propcos, and then combining them.
What do you think are going to be the key challenges that we're going to face in the hotel sector this year?
Cost of debt still remains one of the biggest challenges, although we've seen the trends going in our favor. We've had two rate cuts in the UK and in the Eurozone. It's coming down, but it's still high up. I think it needs to come down to make it more interesting for transactions. Inflation has been a major concern and the biggest challenge. What we saw since 2019 was the average rate grew at a healthy rate. Occupancies were still lagging, but that average rate, whilst in percentage terms seems high, but not high enough to overcome the inflation aspects of it. With average rate now stabilizing or stalling and occupancies catching up, inflation still out there. I think that's going to be one of the biggest challenges. The payroll inflation has been significant across Europe and the UK. Of course, the budget last year was not very helpful. So we see that the bottom line or the sort of net incomes will still be suppressed because of inflated middle of the P&L.
And if we look just at the UK, I think, because that's a good example. Last year, obviously, RevPAR continued to grow, but it was only about 2.6% overall. So it wasn't amazing. London, 1.4%. And if you start to factor in all the costs that are coming in this year, in the next few months, there's going to be a serious impact. And we've already seen some erosion in P&Ls. How do you think that can be mitigated? How do you think about all these cost pressures that we can't ignore anymore?
Because of the average rate increase in the last few years, it's very difficult to push it on average rate again. If we look at average rate inflation, it's sort of more around the 2% mark, as you rightly said. We've sort of factored this cost on the P&L, and it's 3 to 4% impact. It's more than the inflation. So the only respite is occupancy is catching up, and to be able to benefit from that increased demand, and then sort of run through with that over the next 2 years until things stabilize. But very, very little things that can be done to mitigate that 3 to 4% increase because of the budget which was presented last year.
Are you confident occupancy can continue to grow?
We are seeing positive trends across markets, and we remain optimistic that occupancies are falling, especially now since average rates have stalled.
So obviously we're becoming more and more conscious about sustainability issues. I mean, it's in the press pretty much now every day. Nobody can really ignore what's happening. So what is your take at Westmont on ESG, and what do you do for your properties?
ESG is at the heart of what we do at Westmont. We take pride in it. Westmont sort of has a school in Lisbon where it's a business school to aspiring hoteliers, and something we've been committed to do for last several years. More towards our hotels, we are working towards various European government targets of ESG targets, and we are hopeful to achieve those in the next few years. And I think whether no one has a choice on this, the targets are out there. Everyone has to work towards meeting those goals in the next 3 to 5 years.
Have you seen any green premiums in the market?
We are seeing green premiums. They are on the rise. I would say countries like Germany, France are way ahead than many other countries. But we're seeing more and more of those coming into. We haven't started factoring those in our underwriting, but I think it's only a matter of time when we start factoring those.
It's also sometimes the first question we get when we put something on the market: where are we on the taxonomy of the asset?
And I think that'll be a key factor as well in driving the transaction volume over the next 2 to 3 years, because most of the assets which have been held in the long term need significant capex, and most of this is defensive to adhere to the ESG regulations. And that would be a driving factor for a lot of investors to put it out in the market. With interest rates coming down now, I think we will see a lot of volume for those assets coming to the market now.
So now looking a bit to the future, when we did Business Outlook, we did a survey across hotel owners and investors to see what were their plans for 2025. And actually 63% of people say they were either looking to buy or to sell this year, which is good and reflects what we have both been seeing since the beginning of the year in terms of activity. So generally wise, we think there might be less portfolio activity in the UK, because I think we're aware of deals maybe in other countries which will drive some portfolio activity. We're going to see more transaction and possibly quite a lot of non-core and individual asset coming to market. So what are your views in terms of what we can expect for this year?
At least talking from a Westmont's perspective, we, on behalf of our several partners, plan to put few of our assets in the market. We think it would be a good timing this year. Again, reflecting on interest rates coming down and the positive general outlook of the European market. So we'll see how that goes on, but that's the intention. In terms of buying, we're always out there looking for value add deals, opportunistic deals, and that we think we will continue to, and it should hopefully be a positive year for that, given all the assets which have been on hold for the last few years would come to the market. There's a lot of capital out there chasing deals, so that's also driving the pricing to a certain extent. We think all that would follow through into 2025. And as we discussed, the trends of transaction volume are rising, and we'll see a decent uptick in activity this year.
Do you think we're going to exceed the 20 billion euros this year?
I have a feeling we will, Carine. All the pointers are pointing towards that direction.
It's always difficult to know because the first months of the year is always a tough one. But then it picks up. But I think, yeah, as we discussed, based on activity pitching, what's coming to market, probably this year we should see people have decided to move because they need at some point to.
You made a very good point by saying the first month of the year is an important one. And January this year was unusually busy. If what you're saying is true, and if what we've seen in January is true, I think we could be in for a good 2025.
What's your view on pricing? And do you think we can still find double-digit IRR opportunities?
We were hoping for pricing to come down last year and the year before. We didn't see much movement relative to the interest rates. Now the interest rates are coming down, the SONIAs, the Euribors are coming down. With pricing staying where it is, just this element of interest rates coming down would help the transaction volume and would fuel transactions this year.
We do a pricing index every year for the UK, and ours went up by 3.8%. So I think it's the debate every year, but generally pricing doesn't look like it's really changed in any way or decreased compared to the previous year where he had decreased a bit, but that on that side, it seems to continue to go up. Okay, so in 2025, you spent obviously a lot of time in France last year. So where are you going to spend time in 2025?
France is still high up there, Carine. I think there's still a lot more to do in France. We're active on a few deals currently in France. Spain, again, follow through from last year with what we're doing with Group Olar. We'll see a bit of an activity in Spain, but largely through greenfield or brownfield developments. Germany, as we said, if we can call it, it's at its bottom. I think when you're at bottom, there's only one direction one can go at. The institutional investors have been holding on for some time now, so there's a limit until when they can hold on to. We hope they would take an optimistic view and put those assets in the market, and those assets would reflect the current pricing. So that's something to watch out. We are quite exposed in Italy. We've got almost over €1 billion worth of portfolio in Italy. We want to capitalize on that and grow more in Italy as well. So I think for us, France, Germany, Italy, and of course UK, we're seeing an increase in activity in London hotels. We would try to keep our attention to those and continue to grow in London and other key cities in the UK as well.
I think UK is going to have another good year because some of these large portfolio will drive probably some non-core disposal at some point this year, which will fuel quite a lot of individual asset transaction. We had a good last year. We did about 100 hotel transactions in total, which is probably for the UK the normal average for us. So that's a good year. But again, more non-core. Italy, just the beginning of the year, we've already looked at 4 projects in 4 weeks, pretty much. Disposals as well. So I think there will going to be more activity. France has continued to be superbly busy. Big portfolios are also in the market, either in some sort of administration or general sales. So I think France is going to have a good year, and Spain remains a big favorite. But we've also seen a bit more activity in the Nordics and in Netherlands as well. So no, I think generally across Europe is going to be a very busy year.
We expect to see a lot of big boxes coming to market in London this year. So I think that would be the characteristic of London this year. The only exception to what you said is Netherlands. We think that Netherlands is going through tough times because of governmental policies, high inflation, and limited RevPAR growth. We are overexposed, and we are exposed in Netherlands. We would like to hold on to that and look for opportunities to grow that platform as well, but carefully. But beyond that, you're right. The rest of Europe looks positive, and there's a lot to do.
Thank you so much for your time, Saurabh.
Pleasure.